These are main objectives for today's news. Discuss the relationships among pricing, image, competition, and value. Describe effective pricing techniques for introducing new products or services and for existing ones. Explain the pricing methods and strategies for retailers, manufacturers, and service firms. Describe the impact of credit on pricing. Describe how to prepare the basic financial statements and use them to manage a small business. Create projected financial statements. Understand the basic financial statements through ratio analysis. Explain how to interpret financial ratios. Conduct a break-even analysis for a small company. Explain the importance of cash management to a small company success. Differentiate between cash and profits. Understand the 5 steps in creating a cash budget. Describe fundamental principles involved in managing the big three of cash management, accounts receivable, accounts payable, and inventory. Explain the techniques for avoiding a cash crunch in a small company.
Live mula sa tahanan ng Marketing Network, narito ang Group 4 na katutok 24 oras. Magandang hapon, Luzon, Visayas at Mindanao. In launching a product or service, there are different factors to be considered. First is the product, the people, the promotion, place, physical evidence, and lastly, its price. So what is price? Price is the amount of business charge its consumers for its products and services. Setting a price is a business decision by both art and science. Entrepreneurs must determine prices for their goods and services that will draw customers and produce a profit for the company. There are 3 potent forces of pricing. First is the image. A company pricing policy communicates important information about its overall image to the customers. Pricing sends an important signal to customers about the company, its brand, its position in the market, the quality of its goods and services, the image it wants to create, and other important concepts. Example for this is the Starbucks company. It is a known brand coffee because of their quality goods and services. They built their brand based on the consumer wants and also the quality and experience of their consumers after purchasing their product. It is the main reason why customers are still willing to pay because the image of this brand is good in the market.
Competition-based pricing. It is also known as competitive pricing. It consists of setting the price based on the competition is charging. This pricing method is normally used by the businesses selling similar products, since services can vary from business to business while attributes of the product remains similar. Last is the value. The right price for a product or service depends on one factor: the value it provides for the consumer. Entrepreneurs may recognize the objective value of their products or services, which the price customers would be willing to pay if they understand perfectly the benefits of their product.
Introducing a new product. Most entrepreneurs approach setting the price of the new product with a great deal of apprehension because they have no model on which to base their decision. If the new product price is high, it is in danger of failing because of low sale volumes. However, if the price is too low, the product sales revenue may not cover the cost. When pricing any new product, the owner should try to satisfy 3 objectives. First is to get the product accepted. Price must be accepted to the company's potential customer. The acceptable price range for a new product depends in part on the product position. There are 3 product positions. First is the revolutionary products, new and unique that they transform existing market. The acceptable price range for the revolutionary products tend to be rather wide, but the business introducing them must be prepared to make the investment in educating customers about them. Second is the evolutionary product. Offer upgrades and enhancement to existing product. The acceptable price range for the evolutionary product is not as wide as is for revolutionary product. Companies that introduce evolutionary products with many new features at prices that are too low may initiate a price war. The last one is the Me Too product. It offers the same basic features as existing products on the market. The acceptable price range for these products is quite narrowed, and many companies introducing them find themselves left with Me Too pricing strategies that are the same or similar to those competitors. The second objective is to maintain market shares as competition grows. If a new product is successful, competitors will enter the market and the small company must work to expand or at least maintain its market shares. Continuously, reappraising the product's price in conjunction with special advertising and promotion techniques helps to retain market shares. The third one is to earn a profit. A small business must establish a price for a new product that is higher than its total cost. Entrepreneurs should not introduce a new product at a price below cost because it is much easier to lower the price than to increase it once the product is on the market. Pricing their products too low is a common and often fatal mistake for new businesses. Entrepreneurs are tempted to underprice their products or service when they enter a new market to ensure their acceptance or to gain market shares quickly. Three basic strategies to choose from when to establish a new product's price. First, penetration. If a small business introduces a new product into a highly competitive market in which large number of similar products are competing for acceptance, the product must penetrate the market to be successful to gain quick acceptance and extensive distribution in the mass. Second is skimming. A skimming pricing strategy often is used when a company introduces a new product into the market with little or no competition or establish the company and its product or services as unique and superior to those of its competitors. Sometimes a business employs this tactic when introducing a new product into a competitive market that gain an elite group that is able to pay higher price. Third one is the life cycle pricing. A variation of the skimming price strategy is called the life cycle pricing. Using this technique, a small company introduces a product at a high price. Then technological advances enable the firm to lower its costs quickly and to reduce the product's price before its competition can. By beating other businesses in a price decline, the small company discourages competitors and gradually, over the time, becomes a high volume producer. High definition television sets are prime example of the product introduced at high price that quickly cascaded downward as companies forged important technology advance and took advantage of economies of scale.
Pricing established goods and services live mula sa palengke ng Parañaque sa report ni Irene.
Odd pricing. A pricing technique to set prices that end in odd numbers to create the psychological impressions of lower prices. For example, 99 pesos, 55 pesos. The products that we usually see in Miniso, Daiso, and Japan Home. Yes. And then price lining, a technique that greatly simplifies the pricing function by pricing different products in a product line at different price points depending on their quality, feature, and cost. Premium pricing, a pricing strategy that involves providing a basic product or service to customers for free but charging a premium for expanded or upgraded versions of the products or service. For example, the Apple products. Dynamic pricing, a technique in which a company sets different prices for the same products and service for different customers using the information they have collected about their customers. Leader pricing, a technique that involves marking down the normal price of a popular item in an attempt to attract more customers who make incidental purchases of other items at a regular price. Geographic pricing, small business whose pricing decisions are greatly affected by the cost of shipping merchandise to customers across a wide range of geographic regions frequently employ one of the geographic pricing techniques. For example, nag-order ka sa Shopee tapos kunyari nasa Visayas ka, tapos yung seller na sa Manila. So, mas malaki yung babayaran mo shipping. Zone pricing, a technique that involves setting different prices for customers located in different territories because of the different transportation costs. Kunyari, nag-Shopee ka, then yung seller taga China. So, iba yung, di ba, in airplane pa yung product bago mapunta sa'yo, ganyan. Then delivered pricing, a technique in which a company charge all customers the same price regardless of their location and different transportation costs. Ito yung mga kanya move, yan, mga tok-tok, diba? Or sa Grab. Then FOB factory, a pricing method in which a company sells merchandise to customers on the condition that they pay all the shipping costs. And discounts, reduction from normal list prices to move stale, outdated, damaged, or slow-moving merchandise or to stimulate sales. Earn discounts. Discounts customers earn by making repeat purchases at the business. Yung earn discount, syempre alam naman natin yun. Kunyari, may Watson's card ka, di ba? May points yun. Tapos yung mga SM Advantage card. Parang kung ano yung points na nakuha mo dun, yun yung madi-discount sa'yo. Then limited time offers. Discounts retailers run for a limited amount of time with the goal of creating a sense of urgency and excitement among customers. Ito kanyari, sa Foodpanda nag-order ka, din di ba may mga time na nag-50% off or 20% off or free delivery yung mga restaurants. Yun. Steadily decreasing discounts or SDD. A limited duration discount that declines over time. Then, multiple unit pricing is a promotional technique that offers customers discounts if they purchase in quantity. Then, bundling, grouping together several products or services or both into a package that offers customers extra value at a special price. Kunyari, bumili ka ng makeup sa L'Oreal, then, di ba, kasama yung foundation tsaka liquid foundation. Parang kung magkasama, bundle sila, so mas mura yung mabibili mo. Kaya bili mo sila ng hindi magkaiba din. Optional product pricing, a technique that involves selling the base products for one price, but selling the options or accessories for it at a much higher markup. Then captive product pricing, a technique that involves selling a product for a low price and charging a higher price for the accessories that accompany it. Then, by product pricing, a technique in which a company uses the revenues from the sale of their products to be more competitive in pricing the main products. Suggested retail prices. Many manufacturers print suggested retail prices on their products or include them on invoice or in wholesale catalogs. Small business owners frequently follow this suggested retail price because doing so eliminates the need to make a pricing decision. Kunyari, di ba? Sa mall, 5 pesos lang yung sabon. Then, pag sa store na, 7 pesos or 8. Follow the leader pricing. Small companies make no effort to be price leaders in their immediate geographic areas and simply follow the price that their competitors establish. Kanya, bumili ka sa tindahan, din yung price nila is 7. So, yung kakompetensya is 7 din siya.
Pricing strategies and methods for retailers. Markup, called as markup, the difference between the cost of a product or service and its selling price. Markup can be expressed in peso or as a percentage of either cost or selling price. Peso markup equals retail price minus cost of the merchandise. Percentage of retail price markup equals peso markup over retail price. Percentage of cost markup equals dollar markup over cost of unit. For example, if a shirt costs 100 pesos and a retailer plans to sell it for 150, the markup will be as follows. Dollar markup equals 150 pesos minus 100 equals 150. Percentage of retail price markup equals 50 over 150 pesos equals 33.3%. Percentage of cost markup equals 50 pesos and over 100 pesos equals 50%. Pricing concept for manufacturers. Cost plus pricing. A manufacturer establishes a price that is composed of direct materials, direct labor, factory overhead, selling and administrative costs, plus a desired profit margin. Direct costing and pricing. Absorption costing, the traditional method of product costing in which all manufacturing and overhead costs are absorbed into the product total cost. Variable, direct costing, a method of product costing that includes in the product cost only those costs that vary directly with the quantity produced. Contribution margin, the amount left over out of $1 of sales after variable expenses are paid that contributes to covering fixed expenses and earning a profit. Contribution percentage equals 1 minus variable expenses over revenues. Packet price, the price of a company received for a product or service after deducting all discounts and purchase incentives.
Hala. So let's talk about the impact of credit on pricing. So what is credit cards? So credit card is a thin rectangular piece of plastic or metal card issued by financial institutions which lets you borrow funds from a pre-approved limit to pay for your purchases. The second one is interchange fee. What is interchange fee? The fee banks collect from retailers whenever customers use a credit or debit card to pay for purchase. Debit card. So I have example of debit card. Oh my god. Yeah. Here's the debit card. A debit card is a payment card that deducts money directly from a consumer's checking account when it is used. Also, called check cards or bank cards, they can be used to buy goods or services, or to get cash from an automated teller, machine, or merchant who let you add an extra amount into a purchase. Mobile wallet. What is mobile wallet? Mobile wallet applications that link a smartphone or tablet to a credit or debit card, transforming the device into a digital wallet. The next one is installment credit. Installment credit is simply a loan you make fixed payments toward over a set period of time. Trade credit. So let's talk about trade credit. Means many things, but the simplest definition is an arrangement to buy goods and or services on account without making immediate cash or check payments. Layaway. What is layaway? So, a customer selects an item, pays a deposit on it, and makes regular payments on the item until it is paid in full.
The basic financial statement. Financial statement is a process that provides entrepreneurs with relevant financial information in an easy-to-read format on timely basis. It allows entrepreneurs to know not only how their business are doing financially but also why they are performing that way. Balance sheets. Financial statements that provides a snapshot of a business financial position, estimating its worth on a given date.
Income statement. It is a financial statement that shows you the company's income and expenditures. It also shows whether a company is making a profit or loss. Of goods sold. It is the direct cost, the cost of goods sold. This is the direct cost of producing goods sold by a company. This amount includes the cost of materials and labor directly used to create the good. This includes the shipping of the product, the raw materials, and etc. Expense. This includes the costs that contribute directly to the manufacturing and distribution of goods. This includes the rent and utilities, wages and salary, accounting and legal fees, property tax, business travel, interest paid on debt, and overhead costs.
The statement of cash flows. A financial statement showing the changes in a company's working capital from the beginning of the year by listing both the sources and the uses of those funds. The amount of money needed to begin to business depends on the type of operation, its location, inventory requirements, sales volume, and many other factors. Every new firm must have enough capital to cover all startup costs, including funds to rent or buy plant, equipment and tools, and to pay for advertising, wages, licenses, utilities, and other expenses. In addition, an entrepreneur must maintain a reserve of capital to carry the company until it begins to generate positive cash flow. Creating projected financial statements. Creating projected financial statements help entrepreneurs to transform the business goals into reality. Projected financial statements for a small business. One of the most important tasks confronting the entrepreneur launching a new enterprise is to determine the amount of funding required to begin operation as well as the amount required to keep the company going until it begins to generate positive cash flow. The projected income statement. When creating a projected income statement, the first step is to create a sales forecast. An entrepreneur has two options: to develop a sales forecast and work down, or to set a profit target and work up. The projected balance sheet. In addition to projecting a startup's net profit or loss, an entrepreneur must develop a pro forma balance sheets outlining the fledgling firm's assets and liabilities. Assets. Cash is one of the most useful assets in the business owns. It is highly liquid and can quickly be converted into other tangible assets. Liabilities. To complete the projected balance sheets, the owner must record all of the small firm's liabilities, the claims that creditors have against its assets. Magbabalik ang 24 oras.
So, welcome sa ating Shopee Wheel, kung saan pwede kayo manalo ng Gcash. Yeah. So ito na yung ating first wheel. So, habang naghihintay tayo ng winner, so, shoutout muna tayo. So, shoutout po kay Moira at sa asawa niya si Yunjay from Lauren. So, shoutout sa iyo, Moira. Pa-shoutout din sa family ko, dyan sa Cavite, and pa-shoutout kay Reese Reveche from Lorvie. So, shoutout sa iyo, Reese. Next naman. So, we have our winner. So, congratulations. So, ating second wheel. So, pa-shoutout kay Lauren and sa 17 from Moira. So, mga K-pop lovers. So, shoutout din kay Raf from Jerome. And pa-shoutout din kay Luis and Joaquin from Harold. So, shoutout sa inyo. And last is pa-shoutout kay Borja and JM and Raf from Kate. So, thank you so much, Sir Ross. I'm happy to share you. Thank you so much. So, mga winners natin, please contact us through Messenger. So, thank you. Ratio analysis. A method of expressing the relationship between any two accounting elements that allow business owners to analyze their company's financial performance. Liquidity ratio. Tell whatever a small businesses will be able to meet its short-term financial obligation as they come due. Alamin natin ang 12 keys of ratio. Coach AR.
Good afternoon, everyone. I am one of your hosts for today, and I am AR Resurrection. And first, we're gonna talk about the 12 key ratios. And for this topic, the first one is the current ratio, which measures a small firm's solvency by indicating its ability to pay current liabilities or debts from current assets over current liabilities. And then next is the quick ratio, sometimes called the acid test ratio, is a more conservative measure of a company's liquidity because it shows the extent to which its most liquid assets over its current liabilities. So for this, it's quick assets over current liabilities. And then for the next one, we have Dep Ratio, which measures the percentage of total assets financed by a company's creditors compared to its owners. So for this, it's total debt or liabilities over total assets. And then fourth is the debt to net worth or debt to equity ratio. Expresses the relationship between the capital contributions from creditors and those from owners and measures how highly leveraged a company is. So for this, it's total debt or liabilities over tangible net worth. And then fifth is the times interest earned ratio, which measures a small firm's ability make interest payments on its debt. So earnings before interest and taxes over total interest expense. And the sixth one is average inventory turnover ratio, which measures the number of times its average inventory is sold out or turned over during an accounting period. So for this, it's cost of goods sold over average inventory. Next, the seventh is average collection period ratio, which measures the number of days it takes to collect accounts receivable. For this, it's credit sales over accounts receivable. And then 8 is the average payable period ratio. So it measures the number of days it takes a company to pay its accounts payable. So for this, it's purchases over accounts payable. And then 9, net sales to total assets ratio. So this one measures a company's ability to generate sales in relation to its asset base. So for this, it's net sales over net total assets. And then the 10th one is net profit on sales ratio, and it measures a company's profit per dollar of sales. So it's net profit over net sales. Then 11 is the net profit to assets ratio, and it measures how much profit a company generates for each dollar of assets that it owns. So it's net profit over total assets. And the last but not the least, the 12 is net profit to equity ratio. It measures the owner's rate of return on investment. So it's net profit over owner's equity or net worth. Interpreting business ratios. So for this, ratios are useful yardsticks when measuring a small firm's performance and can point out potential problems before they develop into serious crises. However, calculating these ratios is not enough to ensure proper financial control. In addition to knowing how to calculate these ratios, entrepreneurs must understand how to interpret them and apply them to managing their businesses more effectively and efficiently. Many entrepreneurs use these financial ratios as performance dashboard that help them manage by continuously assessing trends in the financial strength of their businesses.
Break-even analysis. The level of operation, sales, or production quantity at which a company neither earns a profit nor a loss. Calculating the break-even point. An entrepreneur can calculate a company's break-even point by using a simple mathematical formula. To begin with the analysis, the entrepreneur must determine fixed costs and variable costs. Fixed expenses are those that do not vary with changes in the volume of sales or production. Example, rent, depreciation expense, insurance, loan payment, and others. Variable expenses, on the other hand, They vary directly with changes in the volume of sales or production. For example, raw materials costs, sales commissions, wages, and others. A break-even analysis is a useful planning tool for the potential small businesses owner, especially when approaching potential lenders and investors for funds. It provides an opportunity for integrated analysis of sales volume, expenses, income, and other relevant factors.
Take a minute! Dahil nga bawal lumabas, tuturuan tayo ni Kim Chu paano ba i-compute ang break-even. Steps to compute the break-even point. Step 1. Forecast the expenses the business can expect to incur. Step 2. Categorize the expenses estimated in Step 1 into fixed expenses and variable expenses. Step 3. Calculate the ratio of variable expenses to net sales. And then Step 4. Compute the break-even point by inserting this information into the following formula. Total fixed costs divided by contribution margin expressed as a percentage of sale. And then break-even point in units. Some small businesses prefer to express the break-even point in unit produced or sold. Manufacturers often find this approach particularly useful. The following formula computes the break-even point in units. Total fixed cost divided by sales per unit minus variable costs per unit.
So let's talk about sign of an impending cash flow crisis. Following are signs that a company may be on the verge of a crash crisis. The one is excess supplies of inventory. Large stock of old inventory items that never sold, significant volume of fixed asset purchases such as machinery and equipment. Account receivable that are past due, failing to take advantage of cash, discounts from vendors and suppliers, late payments to vendors and suppliers, missed quarterly tax payments, past due loans payments, above average interest expense because of excessive business debt. Average collection period ratio that is above the industry median. Missed sales because popular inventory items are out of stock. Difficulty meeting payroll on time. Rapid increase in business expenses, rapid increase in account receivable balance, minimal or no financial controls in place to monitor potential debt. Infrequent preparation and use of financial statements as managerial tool. So, cash flow cycle. What is cash flow cycle? So, the time lag between paying suppliers for merchandise or materials and receiving payment from customers.
Cash and profits are not the same. Cash flows, a method of tracking a company's liquidity and its ability to pay its bill and other financial obligation on time. By tracking the flows of cash into and out of the business over a period of time. Cash budgets. A cash map showing the amount and the timing of cash receipts and cash disbursements on daily, weekly, and monthly basis. So ating interviewin ang dalawang ina ukol sa cash budget.
Creating a cash budget requires 5 basic steps. Determining an adequate minimum cash balance, forecasting sales, forecasting cash receipt, forecasting cash disbursement, then estimating the end of the month cash balance.
The following are the benefits of planning cash needs ahead of time. First is, it will increase the amount and the speed of cash flowing into the company. It will also reduce the amount and the speed cash of flowing out of the company. Cash planning enables the organization to have adequate cash flow, which leads to a reduction in the amount of money that flows out of the organization. Thus, it will enable an organization to maximize its profit. Another benefit is make the most efficient use of available cash. Effective cash management allows the company to control its cash and manage its business economically, efficiently, and effectively. In this way, the company can reduce the business disruptions, operate in a smooth and efficient manner, and provide for its ongoing growth and profitability. The company can also take advantage of money-saving opportunities, which will help them to finance their seasonal business needs. Another benefit is develop a sound borrowing program. Cash planning also allows an organization to come up with sound borrowing and repayment plans. Effective cash planning helps the organization to utilize its funds effectively. This will enable an organization to develop a sound borrowing plan since the organization will borrow when it is unable to meet the needs of the company. Another is develop a workable program of debt repayment. Also, planning helps create a debt repayment plan which enables an organization to take care of its debts effectively. You can also impress the leaders and investors with its ability to plan and repay finances. It will also provide funds for expansion for the business future. And lastly, plan for investing surplus cash. Surplus cash is the cash that exceeds the cash required for the day-to-day operation. The two common uses of extra cash are paying down the company debts and investing in company's assets.
Accounts receivable. Accounts receivable is the balance of money due to a firm for goods or services delivered or used but not yet paid for by customers. Accounts receivables are listed on the balance sheet as a current asset. AR is any amount of money owed by customers for purchases made on credit.
Accounts payable. It refers to an account within the general ledger that represents a company obligation to pay off a short-term debt to its creditors or suppliers. Another common usage of accounts payable refers to the business department or division that is responsible for making payments owed by the company to suppliers and creditors.
Inventory. A company's inventory represents one of the most important assets it has because the turnover of the inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. There are three types of inventories, including raw materials, work in progress, and finished goods. It is categorized as the current asset on the company's balance sheets.
Avoiding the cash crunch. So cash crunch occurs when a company is running low enough on cash so that it starts to have an impact on their operations. So next is bartering, which is the exchange of goods and services for other goods and services rather than for cash. And the next is the trim overhead cost. It is the high overhead expenses can strain a small company's cash supply to the breaking point. And simple cost-cutting measures can save up big money. And operating a business efficiently improves its cash flow.
Tignan natin ang lagay ng panahon. Ivan?
Successful owners run their businesses lean and mean, trimming wasteful expenditures, investing surplus fund, and carefully planning and managing the company's cash flow enables them to compete effectively. The simple but effective techniques covered in this chapter can improve every small company's cash position. One business writer says, in the day-to-day course of running a company, other people's capital flow past an imaginative COS opportunity. By looking forward and keeping an analytical eye on your cash account as events unfold, remembering that if there's no real cash there when you need it, your history, you can generate leverage as surely as if that capital were yours.
At yan ang mga balita ngayong Friday na. Ito ang Group 4. Walang kinikilingan, walang pinoprotektahan.
Sinungalingan. Dahil di kami natutulog, nakatuto kami 24 oras.